It was a relatively quiet day on Wall Street. However, we did have a nice bullish tilt towards the end. Most market participants were bidding up the prices of securities into the closing bell. And so while we didn't have a big breakout day or anything like that, we did close near the highs of today's session. So I think there was maybe a little bit of bullishness there. The problem is we're still below falling 30-day moving averages, and most of our indices continue to have bearish postures. So I tend to think that we have more choppy and difficult periods in front of us as we head into the spring. However, there's always opportunities out there. In tonight's video, I'll point out a pharmaceutical stock that was one of today's leaders that I pointed out back in late October as representing a very good dividend growth investment opportunity. We'll also talk about a niche within the European space here today that not a lot of people are probably paying attention to, but we're starting to see some breakouts in some of those charts. And then for our trade application example tonight, I wanted to focus on a dividend aristocrat company with over 40 years in a row of dividend increases that really took a tumble here late last week that might be setting up in some interesting levels here from a dividend yield perspective moving forward. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 8th, 2022. First of all, welcome aboard to those of you who are new. Remember, if you're over on YouTube, be sure to click subscribe on our channel. Also, down below in the description area, you'll find a link for our email distribution list. So if you're not signed up for that already, make sure you do so. Not only do you get the benefit of being notified whenever David and I post our Market Outlook videos, but you'll also find which stocks within the S&P 500 are giving you overbought and oversold cluster signals at the bottom of those emails. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ. We really appreciate those of you that click like and retweet when it comes to those Market Outlook related tweets. And then last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see in the link in front of you. All right, let's go ahead and jump into today's trade activity. It's a pretty bullish day for the market. We did close near the highs of the session, and as we take a look at our S&P 500 heat map here, you can see it is mostly green here today, which we are thankful for. Remember, when you're looking at this heat map, the bigger the squares and rectangles, the larger the companies are, and therefore more influential in a market cap weighted index like the S&P 500. So today was one of those days where we did have large cap technology oriented names helping us along. Stocks like Apple were up 1.8%, Microsoft up 1.2%, Amazon up 2.2%, and Tesla up 1.6%. You did see that Facebook was kind of the exception to that. They were down 2.1%. I guess I should call them Meta these days. Remember, they are a $600 billion company. I got a chuckle when they were playing The Social Network on TV the other day, that movie from several years ago. And at the end of the movie, they talk about how Facebook is now worth $25 billion. And it's kind of like that big aha moment at the end of a movie. Well, here we are, what is it, a decade later, and that $25 billion looks like an afterthought compared to their actual market cap these days. So sometimes those companies come with a lot of controversy early on in their infancy as a publicly traded company, but in Facebook's case ended up 20xing by the time it was all said and done. Obviously stumbling here recently, but a tremendous American success story in that particular case. You did see that energy struggled today, so remember that had not been the case recently. We've been seeing that energy more times than not has been this market's leader. Today they took a back seat to everybody else playing catch up here. You can see vast majority of energy stocks were down here today. I do see one nice bright spot here that catches my eye in the middle, and that is Amgen. Amgen was, if I'm not mistaken, the best performer in the S&P 500 today through its normal market session, up 7.82%. It was also the leading performer within the Dow Jones Industrial Average. Some of you might have seen me tweeting about that earlier. Remember, sometimes I give you a heads up as to what my thoughts are at any given moment within the market. And I recalled a kind of a poll or a question that I responded to back in the fall where European DGI was asking which stocks from a dividend perspective are catching your eye right now. And, there was a lot of interesting answers on there, but I was discussing specifically Amgen, and I said, although I've already owned it for a number of years, if I was buying my very first dividend growth stock right there at that moment in time, and that was October 24th, it would be Amgen. And of course, as I state up here, that since then, and this is again end of October, Amgen was a $207 stock. It's now $242. It's actually a little bit higher than that in real time, but earlier today it was there when I posted this. And so that's a pretty good result considering the particular circumstance that we've had a very difficult market along the way. Remember, the stock market is currently trading lower than where it was in October, which was the whole point of European DGI asking the question, because back then it was like, okay, now what, dividend growth investors, what can we find out there? There's not a whole lot of value to be found because the markets are, quote unquote, high and overvalued. So this just goes to show you that even if you are about to embark upon a stock market that is going to fall, there are still going to be opportunities out there. In this case, you would have been better off putting your money into Amgen at the end of October as opposed to just keeping your money in cash while the stock market itself has gone lower. Will that happen all the time? Of course not. Maybe I got lucky in that particular case, but just a reminder that I do try to share my thoughts with you guys on Twitter along the way. So again, if you're not following me, I would highly encourage you to do that at Brandon Van Z, because I'm going to be sharing my thoughts about the market with you guys between the classes and presentations that I teach along the way. So anyway, I for one was very happy to see Amgen leading the market here today as an outstanding dividend growth investment stock over the years. In terms of other kind of negative performers today, I mentioned the energy already. I would also kind of throw real estate into that category. You can see it wasn't quite as consistently red as energy, but you do have way more components within the real estate sector in those red squares and rectangles, just a handful of them that showed up in the green there. So it seemed like those two were a bit out of favor here today, but for the most part, we did have a pretty successful day when it was all said and done. I particularly like the fact that we closed near the highs of today's session across most of the indices. We do have some positive news coming in after the bell tonight with a lot more companies announcing dividend increases and earnings announcements and all that kind of fun stuff as well. Of note is Chipotle. Chipotle was trading up by about 6 or 7% after hours the last I checked, and then also some of you might have caught me mention the 3M dividend increase, but more importantly, OMC, which is Omnicom, another good dividend growth stock that doesn't get talked about a lot, but that particular company appears to be trading nicely higher after hours at this moment in time as well. Closed at just under 79 and is currently trading closer to about 84 after hours. So just a couple of examples there of companies reporting still after the bell here tonight and sending futures maybe a little bit higher after the normal session has already closed. So hopefully that bodes well for tomorrow morning as we get things started once again. But of course, we do have a lot of earnings to get through. I know it's probably felt like we've already gone through a lot, but there's still a lot more. And there's some big time players even later this week like Coca-Cola and others that will come out with their earnings announcements. So we'll be keeping our eyes on the action, but right now futures are up just a touch here after hours on this Tuesday evening. Let's get into the main kind of foregrid that we have our conversation around the market forecast technical indicator. So this is chart 4B for those of you that are following along at home as premium members of Market Scholars. Notice that we do have strongly bearish postures on 3 out of the 4 charts, and we have strongly bullish posture on 1 out of the 4 charts. So kind of a weird roundup here. Remember, more times than not, the indices kind of track one another, though to various degrees. And as I've been sharing with you guys here in the last couple of months, I've been saying that the Dow Jones Industrial Average, from my perspective, is this market's current leader. We have more evidence to suggest that that is the case here right now, as that is the one out of these 4 indices that does have that strongly bullish posture right now. However, even though it's got a strongly bullish posture, keep in mind it's still got a lot of work to do. It's not like we are wildly bullish on the Dow. It's just that it's holding up better than the others. Notice that the Dow continues to be below its falling 30-day moving average. Remember, when that 30-day moving average is colored red on this foregrid here, it means that price is below the falling moving average, and that is the same with all four of these charts. The background color will tell us whether the intermediate posture on the market forecast is considered bullish or bearish. And so with the intermediate line on the Dow Jones 55 and rising, we would consider that to be bullish, whereas notice in the labels of all of these other charts, they say falling in that green label there. So that's why those other ones are still considered bearish. So we're still in a kind of prove it to me market, I think. I don't think we've crossed the threshold of being strongly bullish or anything along those lines from a broader perspective because of those falling moving averages. If we stabilize here for a month or two and then the moving averages start curling higher, maybe I'm willing to kind of change my mind a little bit on that. But right now I kind of have to make the assumption that we still have some difficult moments in front of us within this market. To put a ribbon on it, you do see that the S&P 500 was up 0.84% today. Dow Jones was up 1.06% today. NASDAQ Composite was up 1.28% today, and the Russell 2000 was actually the day's leader. It was up 1.63% today. So all in all, I would say a reasonably promising bullish day, mostly because I liked how the final hour kind of unfolded, where there was a little bit of choppiness there midday, but then the bulls did kind of gather themselves and rallied the market into the close. And so you can see those nice open candles there on all four of those charts, suggesting that the bulls kind of controlled the price activity on an intraday basis here today. So I think that's at least helpful. We'll see what the future holds and where things will take us. As I mentioned before, I don't think we're out of the woods yet. And when I did the video with you guys last time, I did a bearish trade there on Danaher. I have noticed that stock has fallen since we've done that bearish trade, which I'm happy about. But that's just one example of, if you're not convinced that this market is going to go ripping back to the upside, then you might have to start adjusting your philosophy in terms of your trade expectations and the types and strategies of the trades that you're going to be implementing within your trading portfolios there. Let's go ahead and take a look at our 3 green arrows chart now. And so this will be chart 4D for those of you following along at home. Speaking of which, most of you caught this on the Telegram if you're already one of our premium members, but in case you didn't catch that, I'm speaking directly to the premium members now, but I did update chart 1A. The load times on the previous chart was kind of driving me crazy, to be honest. It was taking several seconds to load up the chart, and so had some adjustments there with some assistance from Mike, and gave me a creative workaround on that. And so the newest update to chart 1A has been posted to our shared ThinkScripts area of our website for those of you that are premium members. So feel free to update your chart 1A as well, because it will load up quite a bit faster than it used to nowadays. Anyway, let's go ahead and take a look here at our 3 green arrows chart, 4D in this case. And it's pretty much the same thing as the last time we reviewed it, which is right now these charts are showing mixed signals. I think the last time we looked at it was the exact same setup in terms of 2 greens, 1 red on every single one of the charts. And the 2 greens are going to be your MACD and your stochastics. So notice on all 4 of the charts, MACD and stochastics are green arrow status right now, but it is the 30-day moving average that remains the boogeyman, so to speak. It's the one that continues to have that red arrow. Remember, that stays a red arrow on the 30-day moving average as long as price is below the moving average. If price crosses back up above the moving average, then there will be a green arrow plotted. And so there's a pretty decent chance that as soon as tomorrow, that the Dow Jones Industrial Average could actually go to 3 green arrow status. Notice that we closed just barely below that falling moving average right there. So remember, the 3 green arrow status does not require that the moving average itself is uptrending. It just requires that the price is trading above the moving average. And so that's why I say, tomorrow it could easily happen. If we have an update in the stock market, there's a very good chance the Dow Jones goes to 3 green arrows tomorrow. Likely won't happen on the other 3 indices because there's enough of an air pocket there on those other charts where, unless it's a really big update tomorrow, that's probably not going to happen. But I'd say there's a pretty decent chance that the Dow Jones could get that accomplished here either tomorrow or perhaps the next time I'm with you with the video on Thursday. Let's go ahead and step away to the internet here briefly. I always like to get a chance to say thank you to those of you that help support these market outlook presentations. Remember, we don't force you to listen to advertising from, I don't know, Blue Apron or some food delivery company or something that has nothing to do with trading or advertising, right? That's not our business model. We don't make money off of advertising. We run a subscription service. So we don't force you to listen to a bunch of advertisements from outsiders, and we don't force you to pay us every time you click play on these YouTube videos. We offer them to you for free, and we don't make any money off of them. Our hope is that we can have a bit of education and train you guys to a degree on YouTube. And for those of you that want to take your next step towards more robust investor and trading education, that some of you might consider our premium services at some point, whether today or down the road. But our hope is that by offering you all of this free research and analysis that David and I have done for years now, that will eventually pay off for us, right? It's a lot of goodwill along the way. But the way that you can thank us is simply clicking like for us on Twitter, right? Just consider it a professional courtesy. If you appreciate the 3 hours that goes into preparing for these videos, producing the videos, editing the videos, doing these paragraph write-ups, sending out the notifications, doing the social media notification, we don't have a team doing that, right? That's David and I doing the whole shebang there. So I know a lot of you get it. That's how it is with a small business. But if you could just do us the one favor of taking 5 seconds out of your day to click like, that will go a long ways there for us. As I always say, as long as we're up and over 100 likes there on Twitter, I'm happy to give you a full-length video. If the motivation isn't there from our audience to click like on Twitter and take that 5 seconds out of that day, and we're under 100 likes, then I'm likely just going to give you a quick little 15-minute quick hitter video only on the indices without a trade application example the next time around. So obviously, if you prefer the more in-depth research and analysis that we provide for you, just put it on your docket to support us on Twitter by clicking like for us every time you think of it there. And we do appreciate those of you that consistently do it. We know there's a whole group of you that will do that every single day, and you are loyal supporters, are near and dear to our heart. So thank you very much for that. Also, while we're over here, by the way, I taught my dividend growth investing class earlier today. That has now been posted, and then David taught his directional option strategies class earlier today as well. Tomorrow, I'll be back in the saddle first thing in the morning with factor-based swing trading, and David will be doing his options inventory class. So some other great classes coming to our premium members tomorrow. While we're over here, let's also check out our sector selector. Remember, this gets updated on Friday evenings, so by the time I share it with you here in the video on Tuesdays, it's a little bit stale. The real reason I build this tool is for discussion within my Monday top-down trend trading class, but oftentimes do share it here in these YouTube videos as well, just to give you a general sense as to what sorts of sector rotation may or may not be taking place. And once again, it is energy that's leading the way. And that's despite today's pullback as well, I would add. Energy has such a tremendous lead over all of the other sectors that energy would likely have to fall for a couple of weeks in a row at a minimum before it would even fall off of the top spot. That's how big of a lead they've built up there. So it's been a peculiar year so far in 2022, but one of the themes is oil and gas is all alone up in the driver's seat. We have seen some advancement here from financials recently. Remember, they tend to benefit, all else being equal, when interest rates rise, particularly when you see that yield spread rising. They tend to benefit from their net interest margin and helps build their earnings up a little bit more, and therefore market participants usually willing to bid up their shares. We did have a successful close of our Key Corp position that we put in I think it was last week's factor-based swing trading class is just one example. So KeyCorp and a lot of those regional banks have been bouncing up and off of their rising moving averages here more recently, and that kind of played a role seeing financials moving up to that number 2 spot week over week. On the downside, you do see that information technology just couldn't stay on the bottom. I made a big deal of that last week because it was so rare that was literally the first time in 4 years that information technology was dead last, and you could see that just wasn't a very comfortable place for them, because 1 week later they managed to at least move one place up, and now they're second to last with consumer discretionary there in that final position. Keep in mind this is on an equal weighted basis how I'm ranking this, and I'm using a multi time period approach towards it. So it gets a little complicated in terms of the math. It's a bit proprietary there, but just understand that sometimes people will say, well, why is this ranked this way when I see X, Y, or Z? And a lot of times the reason is because the other person is using a market cap weighted approach, whereas I prefer the equal weighted approach for our classes purpose on Monday. So be aware of that aspect as well. But in general, kind of some of those key trends continuing to hold, with energy doing well, financials benefiting from rising rates, and on the downside you have some of the more kind of speculative and cyclical areas, industrials, technology, and discretionary. They've kind of fallen out of favor here in recent months. All right, let's go ahead and get back on track here now with some more charting analysis on the Thinkorswim platform. And let's pop on over here to the 12 grid, starting with chart 5A. So remember, this will be our asset class 12 grid. And just a reminder to those of you that might be new, on these 12 grids, because the charts are so miniaturized, just be aware that the background colors of the charts will tell you what the current posture is, right? It doesn't continue to change, day after day or week after week, like they did on our 4 grid that I was showing you before, because there we have a lot more kind of screen real estate to be able to share that. Here it would just look like it was way too jumbled up if we would do it on these miniature charts. So when you look at these charts and you see some of them pink, what that means is that right now the posture, according to the market forecast intermediate line, would be considered bearish. When you see the green charts, it means that the posture currently would be considered bullish. So let's have a chat with the bottom rung. Seems like that's kind of where we started our conversation more times than not recently, as a result of those areas kind of being drivers within the market. First, let's start with interest rates. Interest rates rocketed higher yet again today. You can see that the 10-year Treasury yield is now at multi-month highs, in fact, probably yearly highs, and vice versa. And so, by the way, we're at 1.95% on the 10-year Treasury yield. So we're basically knocking on the door of 2% on the 10-year Treasury all of a sudden. Remember, it wasn't so long ago when that was below 1%. So that just goes to show you how quickly things have changed here over the last several months. Now remember, the flip side of rising interest rates is falling bond prices. And you can see over here that did some damage to TLT. Now, that is a chart that I've been watching in particular for this presentation's purposes, because right now we have a paper money trade going on TLT, and I did a bull put spread. I did that initially when we were getting these first clusters over here with the hope that we would see some sort of a kind of clotting of the bleeding that had been taking place, right? That's what the kind of the mindset is if you're going to take a reversion to the mean type of a trade. It's that this chart is bleeding out so badly that it's giving you oversold cluster signals. So if you want to play that bullishly to the upside, or even just neutral, which is technically a little bit closer to the truth with the bull put spread that I did, then you're basically making the bet that the move that caused the stock to go into the oversold clusters will not continue into the future. And after the first couple of weeks of placing that trade, I felt reasonably good about it. I didn't feel great about it because there wasn't a snapback rally, but this type of behavior would have been acceptable. In other words, sideways behavior can create a bullish and successful trade on a bull put spread. It's the behavior in the last week or so that has started to damage that trade, and it's becoming a bit more concerning. You can see for the last 3 or 4 days, it seems like we've just kind of rocketed lower and lower and lower, kind of ratcheted lower, I guess would be the better way to phrase that. So remember, on that particular trade, my short strike was 139. I think that was a $2 wide, if I'm not mistaken. We did the 139 as the sold strike, and I think it was the 137 as the bought strike. So keep in mind that that one might not work out. I did check, and it is underwater now. That was not the case a week or two ago. But with this move lower in the last week, that trade has now started to lose us money. Unfortunately, you're not going to win them all. So we'll see where it takes us. Keep in mind that because of this big move lower here on TLT, we have yet more oversold cluster signals. It's starting to produce quite a few of them. And that is not particularly normal for TLT. If you look back throughout history, it usually doesn't have a ton of clusters. So this is a bit peculiar, and it gives you a sense of what we're dealing with in the market right now. This has been a more extreme interest rate environment that we find ourselves in all of the sudden. So keep your eye on Telegram. It's possible I might end up shutting that trade down before expiration date, but I'm kind of hoping that we get some sort of a move back towards that moving average there off of these most recent clusters. And if that's the case, we shouldn't have too much of a trouble getting from 138.17 back above 139 again. As long as it was above 139 on expiration day, that would end up being a max gain trade. It's just a matter of whether I'm willing to kind of ride it till the very end or not. And haven't quite made up my mind on that one yet. It might very well be one that we just need to sacrifice and call it good and dust ourselves off and find another trade somewhere else. So anyway, that seems to be one of the stories of the day, is interest rates continuing to surge higher. Other stories to be aware of, let's talk about these commodities down on the bottom rung as well. Notice that oil had a tough day today. So again, probably not a big surprise, as we've had that conversation here just earlier on our heat map on the S&P 500, where pretty much every single oil stock was down today. That usually happens when oil prices themselves are down, and of course that is the case here today. So this is actually the second straight down day for oil prices themselves. But as you look at this chart down below here, obviously still in a significant uptrend. So it's going to have to sell off a heck of a lot more before we think that the trend is broken. It still has a strongly bullish posture, not just weakly bullish like gold, strongly bullish with that darker shade of green there, and of course remains above that rising 30-day moving average. Speaking of gold, it's had a pretty nice move here lately. I've been talking for, I think, at least 2 or 3 months at this point about how I thought GLD would represent a very interesting iron condor candidate, and instead of just yammering about it, I should have just been taking the trade this entire time, because as you can see, gold continues to basically just go sideways, which is perfect conditions for an iron condor. It did have a nice 3-day rally that we've been kind of dealing with here more recently. So I think it's kind of tilted a little bit more bullishly here, but obviously this chart looks a lot different than the oil chart. The oil chart's actually in a strong uptrend. Gold is just kind of goes in fits and starts. It kind of feels like, 2 steps forward, 1 step back, just trying to figure itself out. So it's in a more bullish point now, but we also have to remind ourselves that in the past, when gold's been in a more bullish point, has been actually a time to sell it, not to buy it, because when you have a sideways chart, that's just how it works, right? The moment it goes bullish, like it did over here, you would have been better off selling it. The moment it goes bearish, like it did back here, you'd have been better off buying it, right? And that's the nature of a sideways chart in general, which is why you got to be careful with those types of charts. Whereas you try to play the trends a little bit more on something like oil, where you buy the dips within a stronger uptrend there. Anyway, gold had a reasonably good day. It was up 0.31% today, has a weekly bullish posture, and does trade above its rising 30-day moving average. U.S. dollar has been kind of just flatlining here in the last 4 days, but remember, that's after having quite the plunge and really just dramatic trading altogether in the prior couple of weeks. It looked like it was breaking out to the upside for basically 1 day, and then immediately unwound that for 5 days in a row, and now has really been just kind of passing time going sideways there. But because it's not making progress, in other words, you had this big up move followed by a big down move. So you would maybe expect that a big down move would be followed by a big up move if there was some bullishness in this. But that's not what's happening right now. I'm not here to say that it can't happen. I'm just saying it's not. And therefore, it is possible that this chart for the US dollar is now considered a bit more bearish than what we might have thought about, a month or two ago. You can see that price is below a falling 30-day moving average, strongly bearish posture in that particular case. In general, I don't mind operating within a weak dollar environment. I find that that's a little bit better for stock trading purposes, but every environment is different. So we'll keep our eye on that story, and if things change, we'll let you know. Bitcoin has continued to impress. It was a couple of weeks ago I said, hey, this is kind of an interesting point for those of you that want to speculate on this highly speculative cryptocurrency to take some action around those levels. We talked about how it was nearing that kind of double bottom zone from back in, I think it was June of last year as well. This is a 3-month chart, so you don't see it right here. But point is, when it got down here around 33,000, we were basically right within that range of where market participants that have been waiting for a pullback might have got the pullback that they wanted as you got close to those lows from in the summer. And we have seen some really nice activity out of Bitcoin here, especially more recently. A week ago, it was a little bit concerning. I remember having the conversation with you where I said, well, it's up about 12% since I mentioned it last week, but for Bitcoin's purposes, 12% is really not that big of a deal. So while it's up nicely off the lows, it kind of just meandered its way a little bit higher. So, I wasn't necessarily too enthusiastic about it at that point. Now, with, several more days of trading since that conversation, things have stabilized even further. And you can see that with this move in Bitcoin over the past week, we're back above that 30-day moving average. Notice all those oversold cluster signals along the way. So people were definitely throwing in the towel on that cryptocurrency. And it's possible that the weak hands were flushed, and it's time for the strong hands to take over once again. So it's going to be interesting to see where Bitcoin goes from here as well. The only foreign chart that has kind of the green background, or the only kind of major geographical chart, I guess you might say, is foreign developed stocks. As you can see up here, does have that light green color. EFA was up 0.51%. Remember, that would represent major swaths of Europe, Japan, Australia. And they appear to be doing maybe a little bit better, according to the market forecast, than the emerging foreign stocks. It's kind of hard for me to say that with my own eyes, because I do see that EEM is trading slightly above its moving average, whereas EFA is not. But again, that's my eyes. The market forecast technical indicator, which controls the background color of these charts, is kind of telling us different information there. So maybe some kind of hidden strength that not a lot of people are recognizing within EFA. I was tweeting about some European banks over the weekend. Some of you might have caught that. In particular, I was talking about Deutsche Bank, the big German bank, and how it was breaking out to multi-month highs. And it kind of felt a little peculiar to be pointing that out on Twitter, or really anywhere, because those of you that have been around long enough will recall that it wasn't so long ago when it kind of felt like Deutsche Bank was about ready to go completely belly up, like literally pull the plug on the company and bury it type of a thing. So it's had a pretty interesting rally or recovery here in recent months. And I'd also throw in HSBC. Both of those kind of caught my eye over the weekend. So Deutsche Bank is DB here in the United States. You can see that huge move higher there in Deutsche Bank, just especially in the last couple of weeks. And then HSBC is another London-based bank, although they do a lot of business in Hong Kong. You'll notice that's also a very strong chart there. So just a very small microcosm of some of the developed world, British banks and German banks seem to be kind of pepping up here just a little bit more recently. All right, let's go ahead and take a look at our Sector 12 grid. And that will be chart 5C for those of you following along at home. All right, so as this pulls up here, you can see we have quite a mix between green and pink background color charts here. It wasn't so long ago, maybe a week and a half ago or so, all of these charts were green. So things have kind of had a little bit more wear and tear over that time period. And that didn't come as a huge surprise to me because I did go out of my way to point out to you guys that despite the postures being, quote unquote bullish according to the market forecast, that many of these sectors were still trading below their falling 30-day moving averages. So I wasn't sure how much I could trust that information. And so now you're kind of starting to see that shake out a little bit more, where some of these charts that were, light green a week or a week and a half ago have now kind of started to give in to some of the selling a bit more. So it's kind of an interesting market where we've got a lot of different looking charts here all of a sudden. Again, it is energy that is our leader here from an intermediate perspective. You can see that its intermediate reading is up there at about 94. Remember, that cannot go above 100, so that tells you how strong energy has been. Beyond energy, you do have kind of a couple of what I would call honorable mention candidates from a sector perspective as well. And it's the same two that I've been mentioning to you guys last week as well, which is financials and staples. Notice that the financials have made a really strong move back above their rising 30-day moving average, now have that strongly bullish intermediate posture, and their intermediate reading is up there at 66. So it has not reached the upper reversal zone above 80 yet, but it seems like it's trying to get there. I'm not sure if it will because it's had to exert a ton of energy just to get to this point, right? This is a much more volatile chart up here with XLF compared to the staples down below. The staples have kind of been steady eddy to the upside. The financials have been whipsawing all over the place. And sometimes when you get a chart like this that takes a nosedive like we saw here from the middle of January to the end of January, and then you have this immediate V-shaped recovery, once you start approaching those prior highs, the chart is exhausted. The traders are probably exhausted of bidding this particular entity up as quickly as it has. Whereas you don't get that same impression down below with the consumer staples. We did review a couple of nice consumer staples in my top-down trend trading class yesterday, Hershey's and McCormick, as a couple of examples of consumer staples that have been trending nicely upwards here recently. I could throw Archer Daniels Midland and Tyson Corp and a handful of others in there as well. Normally, those are the types of companies that we're interested in buying for dividends, but the script has been flipped here. We're no longer interested in most of them from a dividend perspective because most of them's price has gone up and therefore their dividend yield has come down. Now, if they have any interest, they're kind of interesting from a trend trading perspective. So it is a different mindset there, but just kind of goes to show you a sign of the times as towards the type of market that we're dealing with here all of the sudden. So you can see that XLP or the staples has their intermediate line at 59 and rising right now. So it's really those three, and clearly energy is the king of the hill. Beyond those three charts, I think there's a lot of work left to be done. A lot of these charts look pretty ugly, which suggests that there could still be some difficult trading yet in front of us unless we start seeing a lot more of these earnings reports or maybe some good M&A news or something along those lines. But for the most part, I think there's still concerns in this market, and I think we're still going to have some choppy conditions heading into the spring here. So we'll have to do our best with whatever we have at any given moment in time. So let's go ahead and pull up chart 2A now, our dividend stair-step 1 grid. And I'm going to start this conversation actually by heading over here to the internet, because those of you that follow me on Twitter can sometimes get a sense as to what stocks are capturing my attention. And over the weekend, you probably saw a particular theme really since Friday morning. And if I go in here and just type in my name and then CLX, and then look at our latest here to kind of put it in chronological order, you can see that I've been tweeting about Clorox quite a bit. In fact, I talked about it last week in this Market Outlook video on Thursday, but remember, I wouldn't have had the chance to trade it prior to then because by the time I'm doing the videos in the afternoon, the market is already closed. And so I mentioned it in this video that Clorox had gotten blasted that night on Thursday afternoon. As we started heading into Friday morning, you saw Clorox was down 13%. first thing Friday morning. So I was tweeting about it here in the 9 at 9, as I do each and every morning that the stock market is open, faithfully right around that 9 o'clock time period for those of you that want to catch those pre-market movers. I then went on to talk about how it was down 11% and getting close to the attractive blue zone on the Market Scholar's dividend stair-step chart. And I said it was actually trading there at 141.46 or below. So that's that blue portion of the chart there in the pre-market session. And so it ended up kind of bouncing a little bit there when the market ultimately opened, but it was trading below 141.46 Friday morning before the market opened. So I was trying to give you guys a heads up as towards that, especially since this is a well-known dividend aristocrat company, the type of company that you guys probably associate with me a bit more as a blue chip kind of long-term type of a mindset there. And then I eventually went on to say, ding, 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 it did just hit it again there on Friday at 141.46. And I said it was a good reminder in this case for dividend growth investors who might have missed Clorox in its run-up in recent years, that patience within entry can be rewarded. In this case, Clorox is now trading back to its 2016 highs, despite the price rocketing during COVID. So I get the general sense and impression that a lot of people chose to buy Clorox in the last couple of years, despite its yield not being particularly attractive, because they had fear of missing out, right? We've heard that acronym several times. I'm thankful that does not represent my dividend growth investing class, but it is a good reminder that more times than not, if a stock takes off without you and you're trying to lock it down from a long-term dividend growth investing perspective, it's not like it's never going to get back to those attractive levels again. In some cases, you might have to wait years, like we did in the case with Clorox here. But you can kind of see what that chart looks like there, where the last time it was in that attractive blue zone would have been back here in the first part of 2018. That's how rare this has been. And so once it got down to those levels, I wanted to make sure I pointed that out to those of you that follow me there on Twitter, and also started talking about it a little bit more later on that afternoon, because at the time in the afternoon on Friday, I was talking about how it was down 15%. And I'm like, this is totally out of the ordinary for such a traditionally very boring company. Usually Clorox is about as boring as they come. I figured this has got to be one of the worst days in its history. So I went back, and sure enough, according to my research and my records, it was literally the worst day on Friday for Clorox, the worst one-day performance for that company since August of 1999. I was still in college back then, and I was just kind of getting into Wall Street and trading at that time. But that was a heck of a long time ago, just to put that into context of how rare it is for this stock to move, how tremendously it did there on Friday. Not even during COVID times when a lot of companies were getting killed, or even during the dot-com aftermath of 2000, 2001, or the 2008, 2009 financial crisis. None of those days did we see as nasty of a day there with Clorox. And then lastly, I also wanted to point this out, and this is the main reason I wanted to show you this on Twitter, because it no longer exists, but I want to prove to you that it did over the weekend when I was posting about this. I said, while we're obviously only a few days into the month, and this could change by the end of February, right now, Clorox has what appears to be its first monthly market forecast oversold cluster signal on record. In fact, the only other times the green line was below 20, in other words, the lower reversal zone, was 2001 and 2008. And of course, those years should stand out to you as kind of anomaly types of years, the dot-com bubble and the great financial crisis. So I kind of pointed that out here in the chart. This is what I was referencing. Remember, I can spot those clusters because those little green dots appear on our charts that we offer our premium members there. And that is the only green dot you see on this chart. Now, the market forecast technical indicator only goes back to 1993, so I can't say that prior to 93, maybe that would have happened with Clorox, but what I can say is since 1993, Clorox has never once had an oversold monthly cluster. So I'm kind of pointing that out up here with the orange arrow, that this is a monthly chart, not a daily chart, not a weekly chart, but a monthly chart. And remember, the monthly charts are even more rare to get clusters than weeklies, which are more rare to get clusters than dailies. So wanted to point out just how dramatic the trading had been here on Clorox, and yet another reason why I hope you guys get value out of following me on Twitter, because I'm trying to point this stuff out. So we went into Friday's close with it trading at 141.41. And that would have been just below that price that I had mentioned previously on the other chart, the stair-step chart of 141.46 in this case. So basically spot on that blue line is where it ended the session there on Friday. Now, of course, we come into the week here, and yesterday it did bounce a little bit higher than those levels. Now, keep in mind those dividend stair-step charts are built based upon a rolling 10-year time period, and I am currently in the process of recalculating those numbers as I do at the beginning of every calendar year. And so Clorox's average high yield levels from a yield perspective are likely to go down, meaning that the levels of the stair steps themselves will go up. So there is that aspect of that as well. And I've kind of explained that to my classes the last couple of days for those of you that are premium members there. But the point is, this is an interesting situation. Now, it is struggling, right? There's typically a reason a stock gets clobbered, right? It's not just random. There are legitimate reasons why people want to sell Clorox. But if you're a long-term dividend growth investor, you got to ask yourself, is the reason that the stock is down temporary or permanent? If the reason that the stock is down is temporary, then that could very well be an opportunity for the long term. After all, whoever bought this dip back here in 2018 is thankful for doing that up until this point, right? And that was a pretty nasty sell-off from 160 down here to like 115 or whatever it was there as well. And I don't even remember what the reason was that it was selling off back then, but I'm sure there was a valid reason why the stock was selling off. But people who were brave to buy that dip when it got into that blue zone there would have been rewarded to eventually see that stock go to all-time highs there during COVID itself. And the same goes for folks who decided to buy during this blue zone back here in 2013, 2014 time period as well. So I'm not here to say that this is going to be a layup, because it's not. There's going to be some challenges to their payout ratios here in the next year or so. But the hope for those of you that are looking to take advantage of this pullback on a high-quality dividend aristocrat company that's raised its dividends for 44 years in a row and produces products that are oftentimes in the number 1 and number 2 category leaders, from a kind of consumer staples perspective that doesn't get dramatically disrupted by technology or by economic cycles, then you maybe feel a little bit braver to take that leap of faith that, yes, everybody else has given up on this stock right now. That's exactly the time that I want to be going sifting through the water, looking to scoop up the babies that might have accidentally got tossed out with the bathwater. Again, the metrics look a little uglier right now as a result of their reduction in earnings and their higher input costs, and I don't think that's going to turn around overnight, but I do think there's a chance that buyers will become attracted at these levels. In fact, Clorox itself is now trading with a market cap of under $20 billion, which means that it could very well become a takeover candidate at some point. We've been hearing the rumors here recently about Peloton, right? Another stock that's gotten clobbered lately, and then all of a sudden, it gets clobbered enough, and there are other people sniffing around saying, hey, you know what? We could maybe use that merchandise. We could kind of fold it into our own business and take out a competitor at the same time. So who knows? Maybe that's in the cards for Clorox here in the future as well. But I did find it to be an interesting situation, which is why you guys found me chatting about it on Twitter so much. Usually, if I'm talking about the same company over and over again 4 or 5 times in a very short period of time, it usually means that is front and center in my mind at that moment in time, and is kind of a more interesting and unique situation. So again, if you're not following me on Twitter and you want to be kind of involved in those conversations, make sure you do click follow at Brandon Van Zee. Now, what we're going to do here in this case for the trade application example, and remember the trade has already been done, but what I did was I did a sold put trade. and I targeted I think it was the 135s in the month of March, and obviously that would be way down here in the blue zone where the dividend yield, if we were forced to take ownership of it at $135 per share, would be even higher than the current 3.24% yield of where this stock traded here today. Again, this one will not be for the faint of heart. This is not one for those of you that are probably more trader oriented, but for those of you that are a little bit longer term oriented, like I consider myself, looking for blue chip companies that have maybe unfairly been punished within the marketplace with the hopes that they will resolve those issues within the next year or so, then I do think that we're kind of entering into that territory where values will eventually be found. Will it be exactly at 135? I have no idea. Will it be right here? I have no idea. But I do think we're kind of in that general vicinity, considering historical considerations here and circumstances where income investors have stepped up to the plate and started purchasing this particular merchandise. So I think I got $1.60 for selling the 135 puts here today. So in other words, I took in $160 in cash today for basically my willingness to buy 100 shares of Clorox at 135 if the stock does continue to fall to below that level on expiration day there in March. And again, that trade was already done during the stock market time period, and I sent the open hours there in the normal open hours, and I sent that telegram out to all of you who are premium members. Okay, so that's what I had for you here today. Hope you got some value and enjoyed the presentation. If you did, I ask one simple thing out of you. Just click like for me there on Twitter. As long as we're up and over 100 likes, I'll plan to do a full-length video for you once again on Thursday, the next time I'm due to do the video. If we're under 100 likes, then I'll just give you a quick little 15-minute version of the indices and some analysis on that. So anyway, I hope you guys have yourself a great rest of the day. I, for one, am giddy this week as we're getting closer to the Super Bowl. If you don't have a team to cheer for, our Rams could use a few more fans, and so feel free to jump on the bandwagon there. But it should be fun festivities as we head into the final weekend of the NFL season there as well. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.